Today we're going to talk about something important, which is that the Federal Reserve has decided to cut interest rates next month. First, let's understand what interest rates are. Interest rates are like the cost of borrowing money. When you borrow money from a bank, like for a car or a house, you have to pay the money back with a little extra, which is called interest. The Fed decides what this interest rate should be, and it affects the whole country. When the Fed cuts or lowers the interest rate, borrowing money becomes cheaper. This usually encourages people and businesses to spend more money. Though currently unemployment is creeping up, meaning more people are losing their jobs and the unemployment rate is almost at 5%. Also, wages are not catching up with how much it costs to live. People might think, hey, if the Fed cuts rates, it'll be cheaper to borrow money and maybe that will help people find jobs and earn more, but that's not always the case. Let's add another problem. House prices are super high. This means a lot of people cannot afford to buy a home. If the Fed cuts interest rates, it seems like a good idea because it would make mortgage payments much lower, which could help some people buy homes. But here's the thing, if borrowing becomes cheaper, even more people will try to buy homes. This could push house prices even higher, making it even harder for many people to afford them. So while it might help some, it could make the problem worse for others. Another big concern is inflation. Inflation is when the price of goods and services go up over time. If the Fed cuts interest rates, it can lead to more spending and borrowing. But if too much money is spent too quickly, it can cause inflation to rise. This means that the cost of goods like food, gas, and clothes could go up, making it harder for people whose wages aren't catching up, meaning cutting rates could make life much more expensive for people. Though cutting rates might help in the short term, it could create problems down the road. If the Fed cuts rates now, they might not have as much room to cut rates later on if things were to get much worse. This is like using up your emergency funds. Plus, low rates can encourage people and businesses to take up too much debt, which can be risky if the economy were to slow down again.